Good morning. My name is Jacob Chikwanda. I will simply talk about a topic called investment appraisal. Okay, how to deal with investment appraisal. Actually, there are 5 performance measures to deal with the investment appraisal or performance management, which is a payback period, the accounting rate of return, as well as the net present value. To deal with the payback period or the net present value, all the figures uses the cash flows. Okay, so now there are times in the questions where you've been given the accounting profits. If you've been given the accounting profit can only be applied if you're using the accounting rate of return. Where you have got accounting profit, you need to ensure that you know the cost of the investment or the value of the investment. This value of the investment, depending on how questions are phrased, you will need to take note of if at all there is a scrap value attached to it, and also the useful life of that investment. If there is a scrap value attached to it, there's need for you to calculate the depreciation value, where you need to take note of the cost minus the scrap value over the economic useful life for you to find the depreciation. It is this depreciation value which you need now to add back to, because the depreciation amount which you're going to find is a depreciation amount per annum throughout the life of the project. If I told the project is 4 years, meaning every year you'll be having the same amount of money. It is this value which you need to add now to the values of the profits given for each particular year for you to have the cash flows. After calculating this, it will now help you to find the net present value. How? You need now to incorporate the issue of the discount factor. If I told the discount factor is 10% per annum, there's now to use these values in relation to the discount factor in relation to each particular year. For example, the discount factor for year 0, because any number to the power 0 is 1. For year 1, you're going to have 10% of year 1, where you're going to use 1 over 1.1 to the power 1. It will give you 0.909. This is for year 1. Now you multiply by the cash flow, which you've calculated by adding the accounting profit by the depreciation. Year 2, you simply use the same present value or the same discount factor of 10%, which will give you 0.826. The same will be applied for all of them. Then you multiply by their cash flows for you to find their present value. It is this present value which you're going to find. You subtract from the initial amount for you to find the net present value. Thank you so much. Good morning. My name is Chikwanda Jacob. I will simply talk about the consolidated statement of financial position. When it comes to consolidated statement of financial position, what is important is that you are simply putting up together different companies. They could be 2 or 3, where you prepare one statement. Okay, so now before you do that, there are steps and procedures which you need to follow before you do that. Okay, because you're talking about different companies where they are accounted differently. Okay, so by bringing up one, so that you make one group consolidated statement of financial position. So now, number 1, you need to take note of the group structure, where you need to show how much the parent is holding in a subsidiary, if at all in an associate. So in most of the questions, there are times you are given you'll be given the percentage that the parent is maybe holding 80% or 70%, depending on how the question is phrased, which is straightforward. And there are also times where you're just given the number of shares acquired in that subsidiary. So on that one, you need to take note of how many total number of shares are in that subsidiary and how many number of shares is the parent acquiring in that subsidiary. So you simply take note of the number of shares, you divide by the total number of shares, the number of shares which a parent is acquiring over the total number of shares of the subsidiary, then multiply by 100%, it will give you the percentage in terms of group structure. That one is very, very important because that one is step one. Now, you need to ensure that you look at the net asset of a subsidiary at acquisition. The net asset of a subsidiary at acquisition. On this one, what you're calculating is the net asset of a subsidiary, the one with the company which is being acquired. So you need to look at the share capital of a subsidiary, not of a parent. A share capital of a subsidiary. You also need to look at the reserves, the share premium, the retained earnings, and also the valuation surplus, if at all it's there. Okay, on that one, you simply pick the ones, a question you'll be told, okay, based on the net asset acquisition, you will need to take note of at the acquisition date and at reporting date and post-acquisition. On this one, you will always be given in the notes that at acquisition, the share capital or the share premium or the retained earnings were this figure. But take note that the share capital at reporting is the same share capital at the acquisition. This is, you need to take note. The same amount which you have at reporting, which is in the statement of in the financial statement where you are picking these figures, that should be the same statement which will be there at the acquisition. At share premium, you will be told be guided in the notes that the share premium value was this amount. You compare with the share premium. In most cases, the share premium at reporting the acquisition is almost the same. But when it comes to the retained earnings, with that one, you will always be guided in the question. So you need to take note of at acquisition what was the retained earnings and that report was retained. If at all there's an increase, you need to record an increase in the post-acquisition. So when you are going horizontally and vertically, it should be the same. Whether you go vertically or horizontally, at the end of the day, at post-acquisition, the same figure should be the same if you go vertically and horizontally. All right. Let's now go, because the value which you're going to find, the value of the net asset at acquisition will be used when calculating the goodwill. Okay. Also, the value which you are going to find at post-acquisition at the end there, the total amount, will be used to separate between the amount which the parent is able to control when they are preparing group retained earnings and also when dealing with the non-controlling interest there. All right. So let's go to step number 3, where you are trying to find the goodwill. When calculating the goodwill, please take note of the parent holding investment at fair value. This one, you can either get it or calculate it, or you'll be given in the notes depending on the circumstance. So there are times you will be given the whole value, and there will be at times you only be given the number of shares and you'll be given the price per share. So you need to take note of the number of shares you acquired, you divide by the total number of shares for you to find the percentage, and then also multiply by the value depending on how the question is phrased, and at times the amount you just be given. So the cost of the shares in the acquisition of this subsidiary was this amount, the broad figure you'll be given. So you simply just get it and put it there when preparing the goodwill. That will be the cost. Then the non-controlling interest. Under non-controlling interest, you need to take note of this one. In most cases, it is given in the notes. If it is not given, you take note of the non-controlling interest, you multiply it by the number of shares. It will always be given in the question. So you simply get it there. So please, you are simply getting the cost of investment. You add the non-controlling interest. Then you subtract from the fair value of net asset acquisition, the one you had calculated in working 2 when you are dealing with the net asset at acquisition. You simply you subtract. Then you're going to have the goodwill at acquisition. This amount, then you need to detect and take note of, did you have any impairment? If at all you had any impairment, you subtract the impairment. Okay? Then you're going to have the goodwill. Okay, after the impairment. All right. So depending on the circumstance, so you need to subtract. If at all the impairment is for an associate, you don't need to include it. The impairment should be related to a subsidiary. If at all we have got the impairment for associate, you don't need to subtract it from there. All right. Step 4, you need to take note of the non-controlling interest. Okay, the non-controlling interest. Depending on step 4 or step 3, this is dependent on how you are phrasing them. Step 4 can also be the group retained earnings, depending on what you began with. But in my slides, I had put step 4 as non-controlling interest, where you simply get the value which you had calculated, or the value which is in the notes, which is the NCI value at acquisition. You get it there, then you get the NCI of post-acquisition. That working 2 which you did under net asset at acquisition, that's the one you get, and you simply apportion it with the one which you're not controlling. Then you add it together, then you subtract from the fair value of NCI. If at all you had any impairment there, now that impairment which you add, the broad impairment, you apportion it to the one which you're not controlling. Then you're going to have the value of your non-controlling interest. Remember, that other value of the percentage which you have got, which you're controlling, you are going to subtract that impairment from the group retained earnings. That's what you're going to do. All right. Okay. So now, step 5. On the group retained earnings, you need to get the parent retained earnings, the parent. When you get for the parent, you get the whole amount of the parent retained earnings. Now you add the post-acquisition of that subsidiary which you had the working 2. Now you apportion it to the percentage, depending. If at all you had 80%, you apportion 80%. Then you less any impairment, and the impairment should also be apportioned the percentage of the control for you to have the group retained earnings. All right, that is on the normal subsidiary and parent consolidated statement of financial position. All right, now if at all you have got an associate, you need to now come up with working 6, which talks about the cost of investment in associate, where you simply get the cost of investment in associate. Then you also get the parent share of post-acquisition in associate, which is your working 5, which yes. Then from there, if at all you had any impairment in associate, you remove it from there. After that, then you're going to have the investment in associate value. If at all there's any intertrade which happened, you also need to incorporate. If at all you had analyzed profit from there, you also need to do the subtraction. If at all they're there, if they're not there, then you simply have the value of the investment in associate. So that is all I had for you. Thank you so much.